Hello, and welcome to our Asia Trade Floor update with Stephen Chang, PIMCO's Asia Portfolio Manager. Stephen, let's start by sharing a quick recap of how global markets have been impacted by the latest US tariff policies.
Thanks, Jingjing. President Trump's tariff announcement have caused major market turbulence as investors reacted to a much larger than expected rise in US effective tariff rate. Asian stock markets have been hard hit because they rely on export to the US, while US and European stock markets also face substantial losses, reflecting fears of a global economic slowdown and potential recession. This situation also challenges the idea of US exceptionalism, which is the belief that US economy is uniquely strong and resilient. With these changes, the US dollar might become less attractive, which could make investment in other regions, including emerging markets, more appealing.
What does this elevated volatility mean for investors?
In such uncertain times, bonds can serve as a stabilizing force in portfolios. Fixed income investments are appealing now due to their low correlation with equities and attractive yields compared to the past decade. As global growth faces potential headwinds from these policy shocks, bonds can help mitigate risk and provide a buffer against volatility. It is crucial to focus on high-quality bonds that can offer both stability and potential returns in this challenging environment.
We've also seen China has announced retaliatory tariffs on all US imports, and the US is also escalating by hiking China's tariffs further. So, Stephen, given all these trade tensions, what is the outlook for China right now?
China has taken a proactive approach by implementing measures to stimulate domestic consumption and strengthen its internal economy, aiming to offset the impact of external trade pressures. Last month, the government unveiled a special action plan that includes increasing residents' income, introducing childcare subsidies, and enhancing workers' rights.
So, given all these measures, are we observing any early signs of recovery or positive developments in China's economy?
We are seeing a recovery in consumer sectors like record movie ticket sales and higher online gaming spending. But these are relatively small GDP contributors, and consumer caution remains evident. In the industrial sector, there is an encouraging uptick in electric car sales, machinery usage, container ship activities, and copper prices, but these might be short-lived gains ahead of tariff. That said, China's focus on enhancing domestic consumption and investing in technology and AI is positioning it to adapt to global trade challenges, which could support long-term growth. Overall, while there are some positive signs, enormous external challenges remain.
What about the property sector? Are we seeing any signs of stabilization there?
We have seen a significant surge in secondary market volumes, up 49%, for example, in Tier 1 cities and double-digit in most other cities. However, this might be a temporary increase due to recent stimulus and a cautious shift from the primary market due to project completion concerns. Now, affordability has improved meaningfully with lower prices and mortgage rates, but weak income expectations still dampen demand.
Thank you. Let's broaden our focus to emerging markets. What's our outlook there?
Emerging market fundamentals continue to show resilience with stable growth and better debt management among previously vulnerable countries. However, the looming threat of US tariff and shifting global supply chains could create both winners and losers, offering opportunities for active managers in the coming year.
How are the central banks in emerging markets responding to these dynamics?
Most EM central banks have slowed the pace of policy easing, while many are expected to cut rates in 2025. But Brazil, for example, is an exception, aggressively hiking rates due to high inflation and a wide fiscal deficit. Conversely, frontier markets like Ghana and Sri Lanka have outperformed thanks to ongoing programs with the International Monetary Fund and improved debt to GDP trajectories. However, navigating US trade policy changes remain a key challenge, with potential for more unpredictable currency movements. As we discussed in our latest cyclical outlook titled Seeking Stability, this environment underscores the importance of diversification and seeking stable returns. We are focused on maintaining high-quality portfolios with sufficient cash to seize opportunity in this volatile environment.
Thank you, Stephen, for sharing your insights. And thank you for watching. For a deeper analysis of our economic and investment views, please read our latest cyclical outlook on PIMCO.com.